Okay, we are starting. Hello everyone. So we're starting class for today, the first class of F9 for March 2019 attempt. Before moving forward and starting any of the lecture, I first want a confirmation from all of you. There are approximately 14 to 15 students connected at the moment live. So just quickly drop me a message at WhatsApp that you have three things working fine. Number one, you are able to see me clearly. Number two, you are able to hear my voice clearly, sorry. And number three, you are able to see the whiteboard where it is written F9 March 2019. So these three things have to be fine in order to start the class. Okay, so everyone has replied positively that everything is fine. So this means we can start the class easily. Okay, since this is our first class as a formality tool, we have to discuss with all of you the course outline of the syllabus. But since this is not a physical class, this is an online class, and many of you may be taking online classes for the first time. So I just want to spend 5 to 10 minutes explaining all of you clearly that how these online classes work. We are not conducting classes through normal Skype software or TeamViewer software, which usually many online teachers use. In fact, we are using the world's best software called GoToWebinar. Okay. Now, how does this work? The working pattern is you have a whiteboard in front of you, like the classroom, where I'm writing stuff, and all of you are able to see that. Plus, you are able to see me as well, like in the class, you can see the teacher. and you are able to hear my voice same like the class. The only difference is that you don't have students sitting right next to you to whom you can talk easily or you can do some stuff with them. You are alone, and that makes these classes good enough to properly focus or to make proper concentration. Okay, now how these classes work. Obviously, I'm teaching you, you all are listening, you're getting the lecture, you have your notebooks in front of you where you can record the lecture, everything like that. Now, your contact numbers, the contact numbers which you have provided to me, these contact numbers have been stored in GoToWebinar software. Okay. And in GoToWebinar software, the lead number, the main number stored is my number. Okay. So whenever I have to send you any message, any diagram, any class link, like you all have received the class link of today's class, all of you will receive the message. I will type that message in GoToWebinar software and all of you will receive it on your WhatsApp. It's connected through WhatsApp. So you must have WhatsApp with you, active WhatsApp with you. You must be able to actively refer to WhatsApp because all communications will be via WhatsApp. You won't get message on your physical numbers. Every message you will receive from this GoToWebinar server from my number, it will be on WhatsApp. Okay. When people who have taken physical classes from me, I will discuss the lecture with all of you and obviously give you copying time. So you need to copy that when I've given you the copying time. After every 20-25 minutes lecture, when I give you copy time, I will also ask you whether you have any confusion, any problem, etc. Or even in the middle of the lecture, you may be facing some queries or you might not understand one step clearly. Again, you have to send question on WhatsApp, same number from which you're receiving messages. Okay, you can send question via a voice note, an audio note. You can also send question via typed message. You can also type. As soon as I receive your message, because the WhatsApp is very next to me. Okay, any of you sends the message, I will be able to see that immediately. It's connected real time. Okay. I will immediately pause the class, stop the class, discuss your question in front of the whole class so that everyone knows what question did you ask, what is the answer of that question, so that your problem is also solved and others' problem is also solved. Okay. On your GoToWebinar software screen, you might be seeing a tab with the name of questions. Don't type your questions there. I won't be receiving your questions from there. You need to send your questions to me via WhatsApp only. Okay, this is how it will work. Okay, we will have 3 classes a week. Okay, in the start and maybe possible in January, mid-January, I will add one more class, the 4th class. Okay, so we will be having. Okay, so we will be starting with 3 classes a week. I will tell you date and time at the end of the class when we will finish the class. It will be 3 classes a week, okay? And maybe in January or mid-January, we have to add 4th class as well, okay? You all need to understand this thing that in March attempt, we comparatively have less time compared to June attempt. Like in June attempt, we have 4.5 months to prepare the course, while in March attempt we only have 2.5 months, mid half December, January and February, that's it, 2.5 months. So obviously if I will teach like this, that for June attempt, I offer, let's suppose, 100 hours. So we have half time March attempt. So let's start with 50 hours. That would be unfair with all of you, right? Just pause for a moment. One student is having problem. Okay, what I was telling all of you that you need to recognize this fact that in June attempt we have 4.5 months to prepare the course, but in March attempt we only have 2.5 months. So if I teach like this, that for June attempt student we, let's suppose, give lectures of 100 hours, while in March attempt we say, okay, we have half time, so do it 50 hours. That would be unfair to you. So we don't have to decrease the number of hours. We don't have to reduce the number of hours. If I'm teaching 100 hours for F9 in June, I have to teach 100 hours in March as well. So how will I make these 100 hours in this short time period? Obviously, we have to take more classes. So rather than having 3 classes, maybe in mid-Jan, we have to move towards 4 classes. The biggest advantage of classes is that there might be instances where students might say, okay, it is not possible for me to attend the class at the timings which I have quoted. Even though we will have classes late evenings means you can easily attend the class after your work, after your office, everything like that. But there might be an instance where you might be seeing that a time quoted by me, you are unable to attend the class at the time. Every class is being video recorded. Okay, every lecture is being video recorded. After the class, if you want recording of any class you have missed, you have joined late, stuff like that, you can simply ask from me recording of that. I will send you a same link of recording. It's slightly different wordings, but you need to request that link. You will request me that link and I will send you on WhatsApp that link so you can see the class again. It is not possible for the physical class, once you have missed the physical class, to attempt it again, to take the class again. But in this video recording, that is absolutely possible. Okay, so these were some of the instructions which I thought are important for all of you to make sure that you understand how this online setup works. Now, after that, we will move towards your paper structure and your course outline. Okay, as far as the paper structure is concerned, the F9 exam, which you will face, like many fundamental series papers, it has three sections. Okay, the first section is section A, which has 15 MCQs worth 2 marks each. So this section is of 30 marks. Okay, section B will have 3 MTQs worth 10 marks each. MTQ stands for multi-task question. This is also of 30 marks. Now, what is the difference between MCQs and MTQs? MCQs are just a random 3-4 liner question with a requirement of 2 marks. Okay, MTQs have a scenario. Okay, it's a scenario, and out of that scenario you have 5 requirements of 2 marks each. Out of that scenario you have 5 requirements of 2 marks each, so that makes 10 marks per MTQ and 3 questions 30 marks. Well, the third section is section C, and section C has 2 long questions, and every long question's worth is 20 marks. 40, 30, 30, 40. This makes total of 100 marks, and obviously the passing marks are 50. You can copy the paper structure, please. Okay, now let's talk about the course outline, that how this course outline of F9 is based. Okay, now paper F9 is based on 6 sections, which are called 6 core sections. Okay, the name of the first section is capital investment appraisal. The name of second section is weighted average cost of capital, also called WACC. The third section is called risk management. Okay, fourth section is called business valuations. Fifth section is called social finance, and the sixth section is called working capital management. Okay, this is the course outline of F9. The first section is called capital investment appraisal. Second is called weighted average cost of capital. Third is called risk management. Fourth is business valuations. Fifth is sources of finance. And sixth is working capital management. Copy this so I can explain you what happens in each section. Okay, now what is the detail of each and every section? Okay, the first section is capital investment appraisal. Capital investment appraisal you might have studied somewhere else in your earlier studies. What happens in this section that you are provided with an investment opportunity. You are provided with an investment opportunity, okay? And you are asked to evaluate, you are asked to assess, you are asked to judge whether you should invest in that opportunity or not. Okay, what happens in capital investment appraisal? You are provided with an investment opportunity in a project, in a question, and then you are asked to evaluate, you are asked to assess whether you think investment opportunity is feasible for you or not. Okay, the second section is weighted average cost of capital, or WACC. You might have heard many times that the Bank of England or the State Bank of Pakistan, they have kept interest rates as 10% or interest rates as 9%. How this interest rate is computed, 10% or 9%, how this rate is computed, this is what you will learn in weighted average cost of capital, or WACC. The third section is risk management. Okay, this is primarily focused on currency risk management. Now remember the name of this section. This is not risk elimination, this is risk management, because you have studied many times that risk can never be eliminated, it can only be managed. Risk can never be eliminated, it can only be managed. So in risk management, you will learn how to manage the risks faced by a business. Okay, the primary risk here is currency risk. Okay, let me give you an example of currency risk, although we will discuss this in detail when we start this section, but just let me give you an example of this. Currency risk. Always remember, whenever you have to pay or receive something in foreign currency, I repeat, whenever you have to pay or receive something in foreign currency, you are always exposed to risk called currency risk. Like, for example, you are in Pakistan, okay, and you have to pay $1,000 to someone after 4 months. Or leave this example, simply you are in Pakistan and you have to pay ACCA examination fees of £100 after 2 months. You all know that you are afraid of a risk, you are feared, you have a risk that you have to pay ACCA examination fees of 100 GBP, £100 after 2 months. There is always a risk faced by all of you that the pound rate may go up. This is called currency risk. Or, for example, you're in Pakistan and you are planning to receive $100 after 3 months from someone. You are planning to receive $100 from someone after 3 months. There is always a risk that the dollar rate may go down. So whenever a person pays or receives in foreign currency, is always exposed to a risk called currency risk. In risk management, you will learn how to manage, minimize this risk. Okay. Then topic for business valuations. In business valuations, you will be provided a data of a running business. In business valuations, you will be provided data of a running business, which is currently running. And you will be asked to find its value. Okay, like for example, you are roaming on the streets and you suddenly see a restaurant which is for sale. Obviously, if you plan to buy that restaurant, you would be interested in getting to know what is its value. So in business valuation, you always are trained to find the value of the business. Like for example, you are going and suddenly you see a textile factory. You plan to buy that textile factory. Again, you might be interested in getting to know what is its value. So in business valuation, you are primarily interested in finding the value of the business. Okay. Topic 5, sources of finance. Whenever a company plans to raise finance from somewhere, it has multiple sources. Whenever a company plans to raise finance from somewhere, it has multiple sources. So in sources of finance, you are ultimately interested in finding the different sources of finance. Like for example, I am a company, I want to raise finance. I have two sources immediately. One source is I can take a loan. Second source, I can get finance by issuing shares. This is called debt and equity. So in sources of finance, the ultimate objective is to check what are the different sources of finance which you are getting, and then recommending to the company what is the best source of finance. Okay. Finally, the last section is working capital management. Working capital means current assets minus current liabilities. So in working capital management, you would be asked to explain how to manage your assets and how to manage your liabilities. Okay. Now these sections which I just told you, these are the core sections. Okay. Apart from these sections, you have two non-core areas as well. The first non-core area is Islamic finance. Second non-core area is basic economics, the macroeconomics and the financial management function. These areas usually come in MCQs. Now you might be very much interested in knowing that, okay, these are the different topics of F9. And I just told you the paper structure as well. So you might be interested in knowing that how will these sections be examined in paper. Now listen this thing carefully. Okay. We have got instructions about only two sections: risk management and business valuations. Okay, we have got information about these two sections: risk management, business valuations. These two sections can never be tested in long questions. Okay, either you will get MCQs of them or MTQs. Like if we check the history of the past papers, as far as students inform us, there is always one MTQ of 10 marks of risk management. There's always one MTQ of 10 marks of business valuation. You will not get tested any long question of 20 marks from risk management or business valuation. Okay, so this sounds good, that there is no long question from this. You will only get MCQs or MTQs, and you can expect that you will get one MTQ from risk management of 10 marks, one MTQ from business valuation of 10 marks. However, the other four sections, the capital investment appraisal, the WACC, the sources of finance, and working capital, there is no instruction mentioned regarding this. Section 1, Section 2, Section 5, Section 6, no information mentioned, which means they can come in long, they can come in MTQ, they can come in MCQ. So for these four sections, 1, 2, 5, 6, you have to prepare long questions as well in the classes, the MTQs in the classes, as well as MCQs in the classes. Okay. However, for the risk management business valuation, no need to prepare long questions, just focus on MCQs and MTQs. Okay, this is our overall course outline of F9. Okay, you can copy this stuff, then I will start further. Okay, so after all of this discussion, if you want to copy, you can quickly copy. We will be starting our studies from section 1, which is capital investment appraisal. Okay, so the first section we will planning to do is capital investment appraisal. Okay, it's the longest section of F9. So this is the section which would be taking the most time from as far as the duration of the course is concerned. Okay, if you check the past paper history from 2007 till 2018, the last 11 years, there hasn't been a single attempt where capital investment appraisal is not tested of 20 marks. So based on the trend, it is confirmed that you're likely to face a 20-mark question from capital investment appraisal, means the major passing marks will be generated from this section. Okay, let's start this section. I will be writing some stuff regarding this. You can copy that and then we will start explaining to you. Okay. Copy this, then I will explain it to you. Okay, so let's start the lecture. Topic number one is capital investment appraisal. And I first need to explain to all of you what exactly capital investment appraisal is. Okay, the thing is, in capital investment appraisal, we need to evaluate whether an investment opportunity is feasible for us or not. In capital investment appraisal, we need to evaluate whether an investment opportunity is feasible for us or not. And an opportunity is feasible if returns are higher than investment. Quite logical. An opportunity will be feasible if returns are higher than investment. And an opportunity is not feasible if returns are lower than investment. If the returns are lower than investment, then obviously opportunity is not feasible. Okay. So that's the basic thing in capital investment appraisal, that you need to evaluate whether investment opportunity is feasible or not. So what exactly is appraisal? Listen carefully. Let's suppose you have $10,000 with you, which you plan to invest. You have $10,000 with you and you plan to invest. Okay. Someone says, okay, invest 10,000 with me. I will return you 12,000. Okay. You have 10,000 with you, which you plan to invest. And someone says, okay, invest 10,000, I will return you 12,000. Is this an investment opportunity? Yes, this is an investment opportunity, that someone is saying invest 10,000 with me, I will give you 12,000. This is an investment opportunity. Okay. Checking this opportunity, evaluating this opportunity, whether you should go in this opportunity or not, is called appraisal. Okay. Like for example, there was a building being constructed in your area. You plan to invest in that building. You go to the builder and builder says, okay, invest let's suppose $5,000 with me, and I will return you this amount. Is this an opportunity? Yes. Checking this opportunity, whether you should invest money with that builder or not, is appraisal. Finally, you go to the bank, and bank says, okay, invest $1,000 with me. I will give you $1,050. Is it an opportunity? Yes. Checking this opportunity, whether you should invest money with the bank or not, is called appraisal. Okay. So evaluating any opportunity is appraisal. This is what you will face in the question. The examiner will give you an investment opportunity that someone is asking us to invest this much amount and they will pay us this much amount in return. In question, you will be getting an investment opportunity. In question, you will be getting an investment opportunity. That F9 examiner will give you a question that someone is asking us to invest $5,000 and they will give us this much amount in return. You must evaluate, which is the requirement, evaluate whether you should invest in this project or not. This is the question of appraisal. Obviously, you will only invest in that opportunity if returns are higher than investment. So if returns are higher, you will invest. If returns are not higher, then you won't invest. So this is what basically appraisal question is, that you will be given an opportunity and you will be asked to evaluate whether we should go there or not. Okay. Now, obviously, we are basically individuals. So we as individuals do not like too much formality in our work. We as individuals, we do not like too much formality in our work. Like for us, appraisal is just a simple task, that there is an investment opportunity and checking whether we should go for that or not is appraisal. For us as individuals, appraisal is nothing. It's just a short thing that, okay, here comes an investment opportunity and we just need to evaluate whether we should go there or not. This is appraisal. In practical world, companies don't do appraisal like this. In practical world, companies don't do appraisal like this. That okay, bring the opportunity, just quickly checking, okay, appraisal is done. Companies don't work that informally. We as individuals do like that. That here comes an investment opportunity and say, okay, checking it, this is appraisal. Companies don't do appraisal like this. Companies follow a complete process of appraisal, which is based on 6 stages. Companies don't work like this, that okay, bring an opportunity, just quickly checking whether we should go there or not, and appraisal is done. No, companies work very formally to check whether an opportunity is good for them or not. They follow a complete process of appraisal, which is based on 6 stages. The 6 stages in front of you are: number 1, forecast capital requirements; number 2, identify suitable projects; number 3, check all projects; number 4, choose the best one; number 5, make investment; number 6, monitor. These are the 6 stages of appraisal. Means companies follow these 6 stages for appraisal. They don't just do like us that, okay, bring an opportunity and just quickly check whether we should go for it or not. They follow a complete process of appraisal, which is based on 6 stages. First, I need to dictate you what happens in each stage. You need to copy that and write that, and after that we will explain in detail each and every stage. Okay, so what is this process of appraisal which companies follow 6 stages? Write down first stage, forecast capital requirements. Write down first stage, forecast capital requirement. The detail of this step is that forecast capital requirements. In this stage, companies try to find how much funds. In this stage, companies try to find how much funds are required for day-to-day operations. Companies try to find how much funds are required for day-to-day operations and how much funds are spare. How much funds are spare? In this stage, companies try to find how much funds are required for day-to-day operations and how much funds are spare. Okay, this is the end of step one, forecast capital requirements. I will explain you later after 5 minutes. That in this stage, companies try to find how much funds are required for day-to-day operations and how much funds are spare. Second, identify suitable projects. Second, identify suitable projects. Once getting information about spare funds, once getting information about spare funds, the companies then try to find suitable projects the companies then try to find suitable projects which fall under the range of spare funds, Once getting information about spare funds, the companies then try to find suitable projects which fall under the range of suitable spare funds, which fall under the range of spare funds. Companies try to find suitable projects which fall under the range of spare funds. Now, step three, check all projects. The identified projects are then checked. The identified projects are then checked. The identified projects are then checked through different investment appraisal techniques. Are then checked through different investment appraisal techniques. The identified projects are then checked through different investment appraisal techniques. To know which is giving the highest return. Through different investment appraisal techniques to know which is giving the highest returns. To know which is giving the highest returns. Step 4, choose the best one. The best project is then chosen. 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 And sent to senior management for final approval. Sent to senior management for final approval. Step 5, make investment. Upon receiving approval from management, upon receiving approval from management, upon receiving approval from management, the funds are invested in the project. The funds are invested in the project. Upon receiving approval from management, the funds are invested in the project. Upon receiving approval from management, funds are invested in the project. Funds are invested in the project. Last step. At regular intervals, at regular intervals, monitoring and supervision needs to be done. At regular intervals, monitoring and supervision needs to be done. Monitoring and supervision needs to be done. To make sure things are going as planned. To make sure things are going as planned. Okay, let's get an understanding of these 6 steps, that what happens in the process of capital appraisal. Okay, we do appraisal like this, that we just see a project, okay, and start evaluating. We just see a project and start evaluating. Okay, is this good for us or not? This is appraisal according to us. I told you companies don't do like this. Companies follow a complete process of appraisal of 6 stages. Okay, the first stage is called forecast capital requirements. Now, what happens in forecast capital requirements? Tell me one thing. You have some money with you. Will you do investment with that money, or investment is done with spare money? The answer is investment is always done with spare money. So in forecast capital requirements, companies try to see how much cash they have in their account and how much cash is spare. Like, let's suppose they might be having 1 million in their account, but 0.6 million or 0.7 million is needed for day-to-day operations. They have 1 million in their account, but 0.6, 0.7 million is needed for day-to-day operations. They can't invest that money. They can only invest the remaining money, the spare cash. So the first step of appraisal done by companies is forecast capital requirements. in which companies try to find how much cash we have for day-to-day operations and how much cash is spare. Now let's suppose from this step company gets to know that 0.5 million is spare. The next step is identify suitable projects. Find projects which fall under the range of these funds. Like for example, you have 0.5 million. You identify suitable projects. You identify those projects which fall under the range of 0.5 million. Now you know there is no need to see projects of 2 million, of 0.6 million, 0.7 million. You need to identify projects which fall under the range of 0.5 million. Now listen this thing carefully. Let's suppose you didn't perform step 1, forecast capital requirements. You didn't know how much cash was spare. Then you started searching suitable projects. One is taking investment of 3 million, one is taking investment of 4 million. And then in the end, you get to know that you don't have sufficient cash. All your effort is wasted. That's why following the process works. Forecast capital requirements, try to find how much cash is required for day-to-day operations, how much cash is spare. Once getting information about spare cash, find suitable projects which fall under the range of these funds. Like let's suppose you identified 3 projects ABC. Okay. Third step, check all projects. You need to check all projects ABC to see which is best. Fourth, choose the best one. The project which is giving the highest return has to be chosen and sent to senior management for final approval. Okay. Once management gives approval, make investment. Make investment means invest funds. Okay. But after investment, don't just leave it. Regular monitoring needs to be done to ensure whether things are going as planned or not. If things are going as per plan, fine. If not going as per plan, then you need to take some corrective action. So companies usually do appraisal like this. Okay, they don't do appraisal like us. Okay, they are just pick up a book, check whether it's fine or not. This is appraisal. That's what we do. Companies do appraisal by following this 6-step process. First, forecast capital requirements. The objective of this step is to find spare funds, identify suitable projects, find all those projects which fall under the range of those funds, check those projects which is giving the highest returns, select the best one and send it to senior management for final approval. Once you receive approval, make investment, and then regular monitoring supervision needs to be done. Okay. Now, when I explain these 6 steps, many students raise a question, and you might have that question in your mind as well, that we have understood all steps, but we have a problem with step 3. We have understood all steps, but we have a problem with step 3. Now, what is that problem? You said, okay, we got information about step 1. We got information about step 1, forecast capital requirements. The only objective is getting to know how much cash is required for day-to-day operations, how much cash is spare. This is the primary objective of forecast capital requirements. Just checking how much cash is required for day-to-day operations and how much cash is spare. The only objective is to get to know what is spare cash. We get step 2 as well. Once you know, okay, we have this much spare cash, find suitable projects. Okay, done. Then, sir, you are saying check all projects to see which is the best one. You are saying in step 3, check all projects to see which is the best one. The question comes in mind. How to check projects? Like, we are completely familiar with step number 1, that according to step number 1, forecast capital requirements, we need to check how much cash is required for day-to-day operations, how much cash is spare. The only objective is getting to know spare cash. Fine. Once we know we have 1 million spare cash, we find suitable projects which fall under the range of those funds. Okay, let's suppose we have 4 projects which fall under the range of those funds. Now you are saying in step 3, how check all projects. Step 3 is check all projects to see which is the best one. Now the question is how to check projects. Okay. Projects are checked through different investment appraisal techniques. The third step is check all projects. How to check projects? Projects are checked through different investment appraisal techniques. There are four investment appraisal techniques to check projects. One is called NPV, net present value technique. Second is called IRR. Internal rate of return technique. Third is called ROS, return on capital employed technique. And fourth is called payback technique. So in step 3, I told you need to check all projects. The question comes how to check projects. Projects are checked through four appraisal techniques: NPV, IRR, ROS, payback. Copy them, please. Okay. So I think now the process is clear that the first step which companies do is forecast capital requirements. The primary objective of that step is to find how much spare cash we have. Once getting information about spare cash, we need to check what projects we have which fall under the range of those ones. The third step, check all projects, finding which is the best one. The best one is selected and then sent to senior management for approval. Once receiving approval, funds are invested and then regular monitoring and supervision is done. Okay, the question that came to mind that in step 3 you are being asked check all projects. How to check projects? Projects are checked through different appraisal techniques: NPV, IRR, ROS, payback. Now NPV would be coming of 12 to 15 marks in the question, and all these techniques are of 4 marks which will come in the question. Okay, and the other techniques are not possible to be computed without NPV. So by default, the first technique of appraisal which we have to learn in our classes is NPV, which is net present value. Projects are checked through 4 appraisal techniques: NPV, IRR, ROS, payback. The first technique we are getting to understand is NPV, net present value technique. Okay. Copy this, please. Okay, so we are starting technique number one, which is NPV, net present value technique. Now, what is NPV? NPV is just the net savings. NPV is just the net savings. And how do you get net savings? You take present value of returns less initial investment to get net returns. NPV is the net return, net present value. For that, you simply have to take present value of returns less the initial investment to get NPV. The rule is if NPV is positive, which means returns are more than investment, accept project. If NPV is negative, which means returns are less than investment, reject project. This is primarily the NPV technique, present value of returns less the initial investment. How do you do it? Okay. Now, don't write this question at the moment. Just a second, please. I'm sending you one picture. Okay. Don't look at the picture which I've sent you at the moment. Just focus on the question again. Okay. Now we're starting technique number one, which is NPV. And NPV is just the present value of returns less investment. If it's positive, accept, negative, reject. How do we get NPV? Look at example number one. Example one says a project requiring investment of 4,000 will generate 2,000 in year one, 3,000 in year two, 1,000 in year three. Interest rate is 10%, fine NPV. Now, project requiring investment of 4,000. What is the investment? 4,000. It generates 2,000 in year one, 3,000 in year two, 1,000 in year three. Interest rate is 10%, fine NPV. Okay. Now, what is the format of NPV? How do you find NPV, net present value? The format of NPV stays. The format also has marks and marking scheme. So make sure you follow the format. You don't use your own format. The NPV format is you first need to make the columns of years. You first need to make the columns of years. Looking at the life, whatever is the life, make one extra column. Like you can see, a project requiring an investment of 4,000 will generate 2,000 in year 1, 3,000 in year 2, 2,000 and 1,000 in year 3. The life is 3 years. The life is 3 years. You first need to make columns of 3 years. But since the life is 3 years, make one extra column. Make 4 columns. 0, 1, 2, 3. Year 0 means now. Year 0 means now. So whatever is the life, make one extra column. For example, life is 4 years, make 5 columns. 0, 1, 2, 3, 4. If the life is 6 years, make 7 columns. 0, 1, 2, 3, 4, 5, 6, 7. Here the life is 3 years, make 4 columns. 0, 1, 2, 3. Once you make the columns, record all inflows and outflows in rows. Record all inflows and outflows in rows. See the question, project requiring investment of 4,000. Record each and every outflow in front rows. Investment of 4,000. There's an outflow or inflow? There's an outflow. Record investment, outflow. How much? 4,000. Investment is always made now. Then you get the returns. You don't get the returns and then make the investment. Investment is always made now to get the returns. So how much is the investment? 4,000. It's made now, year 0. It's an outflow or inflow? Outflow. Will generate 2,000 in year 1. This is inflow, outflow, inflow, return. How much in year 1? 2,000 inflow. Year 2, 3,000. And year 3, 1,000. Is there any other inflow, outflow? No. Look at the format of NPV. First, you need to make the columns. It's a 3-year life, make 4 columns, 0, 1, 2, 3. In rows, record each and every inflow. The first inflow, outflow is investment, 4,000. And then returns are inflows, 2,000 year 1, 3,000 year 2, 2,000 year 3. Investment is always at year 0. If you find any other inflow outflow, there will be more rows as we move forward in the classes, but at the moment there are only 2 rows, investment and returns. There can be another inflow outflow, which we'll see later. Once you are sure that there are no more inflows, outflows, net them all. Net them all to get net cash flow. Now net cash flow of 0 is 4,000, 2,000, 3,000, 1,000. This is net cash flow. Okay. Once you get the net cash flow, multiply this net cash flow by the discount factor. Now, what is this discount factor? You see these cash flows of 1, 2, 3. They are coming in year 1, year 2, year 3. They are coming in later years, year 1, year 2, year 3. Their today's value will be different, right? Their today's value will be different. Now you are receiving 2,000 in year 1, 3,000 in year 2, and 2,000 in year 3. You're receiving it after 3 years, after 2 years, after 1 year. The present value, today's worth of that money will be different. So how to get the today's worth of that money? You need to multiply this net cash flow by discount factor. Now, how will you get the discount factor? Discount factors are pre-calculated, provided to you in the form of a table. You look at the picture which I've sent you on WhatsApp. Quickly open that, please. Okay, if you look at the picture, the heading is present value tables. These pre-calculated tables are provided to you in the exam. Okay, now if you look at the present value tables, these tables are primarily used to convert amounts which are received at later stage into today's terms. Okay, now if you look at the table, you will be seeing columns of percentages, rates, and rows are of years. Columns are of percentages and rows are for years. You need to select the relevant number. It's pre-calculated. Now, what is the rate in this question? You can see the rate in this question is 10%. The rate in this question is 10%. Now, for 10% and year 1, you need to look at 10% in the table. Look at 10% in the table, please. 10% in the diagram in the pic. And year is 1. 10% year is 1. You can see 0.909, 10% year 1. Now for 10% and year 2, 10% year 2, you are seeing 0.826, And for 10% year 3, you are seeing 0.751. Sir, I'm unable to see 10% year 0. Year 0 factor, now factor is not provided in the table. Zero factor is not provided in the table. The factor of year 0 is always 1. Why? Because you are investing 4,000 now. The worth of 4,000 now is 4,000. So it has to be multiplied by 1 to get the same value. However, you are receiving 2,000, 3,000, 1,000 later. The today's worth might be different, but 4,000 invested now has the same worth. When you multiply these net cash flows by discount factor, you get present values. 4,000 into 1, 4,000. Okay. 2,000 into 0.909, 1818. 3,000 into 0.826, 2472. 1,000 into 0.751, 751. Now, if you will net off all these present values, see, this formula will make. How do you net off all these values? You need to add the present value of returns. Returns are positive. You need to add the present value of returns. 1818 plus 2472 plus 751. You need to add all these present value of returns. 5041 and less the investment. What is the investment? 4,000. Does this make the formula? Definitely yes. You need to add all present value of returns. This is the present value of returns for NPV. All these three present values. And less the investment 4,000. You will get the NPV. NPV is 1041 positive. And positive NPV means you need to accept project. Okay, this is how NPV technique works. The format is very important. Whatever is the life, make columns. 4-year life, make 5 columns, 0, 1, 2, 3, 4. 3-year life, make 4 columns, 0, 1, 2, 3. Write all inflows, outflows in rows. The first inflow, outflow is always investment, outflow at year 0. Then see returns which you are getting. Once you are sure all inflows, outflows have been recorded, net them all to get net cash flow. These net cash flows reflect the amount which are being received in future. That today's present value, today's worth will be different. 1,000 received 2 years later and today's worth of 1,000 is different. So you need to convert it into today's terms by multiplying it with the factor called discount factor. Discount factor is from table that's pre-calculated, given to you. Just use the years and the correct percentage. Factor of year 1 is always 1. Factor of year 0 is always 1. Net cash flow to discount factor gives present value. Net of all present values is NPV, positive except negative rated. You can copy this. I will give you 2 more questions to solve yourself. Solve them. If you have any questions in the above 2 questions, in the above question, please ask me. Please do these questions, and if you have any questions, you can ask me on WhatsApp. Let's see the solution of example number 2. I hope everybody has completed example 2. Project costing 6,000 will give 2,000 in year 1, 1,000 in year 2, 1,500 in year 3, 2,000 in year 4, interest rate 12%, fine NPV. You need to make columns. It's a 4-year life. Make 5 columns. 0, 1, 2, 3, 4. Record each and every inflow outflow in rows. The first inflow outflow is outflow. Investment 6,000, always made at year 0. And project is giving return 2,000 year 1, 1,000 year 2, 1,500 year 3, 2,000 year 4. Okay. There is no other inflow outflow. When you're sure there is no other inflow outflow, net them all to get net cash flows. 6,000, 2,000, 1,000, 1,500, 2,000. These net cash flows represent those amounts which will be received in year 1, year 2, year 3, or 4 at later stages. Today's worth may be different. So multiply by discount factor to convert it into today's terms, present values. 12%. These will be seen from the table. Zeros factor is always 1. 12% year 1 you will be finding 0.893, 12% year 2 0.797, 12% year 3 0.712, 12% year 4 0.636. Let's multiply these net cash flows with the discount factor. 6,000 into 1 is 6,000 negative. 2,000 into 0.893 is 1,786 positive, 797 positive, 1065, 1272. If we net them all, NPV is 1080 negative, indicating project should be rejected. Any questions with respect to example 2, please ask. Then let's move towards example 3. Project costing 10,000 will generate 3,000 in year 1, 2,000 year 2, 6,000 year 3. At the end of the project, machine from project will be scrapped for 500, interest rate 8%, find NPV. So again, let's find NPV. First make columns. How much is the life? The life is 3 years. You need to make 4 columns. Okay. 0, 1, 2, 3. Okay. Then each and every inflow outflow recorded in rows. Project costing 10,000. First inflow outflow is investment. Now, made now, 0, 10,000. And it will generate return. 3,000 year 1, 2,000 year 2, 6,000 year 3. Now that doesn't end here. There can be many inflows outflows. At the end of the project, machine of project will be scrapped for 500. Now if at the end of the project machine is scrapped for 500, this will create an inflow or an outflow. It will create an inflow. How much inflow? 500 at the end. Since there are no other inflows outflows, you need to net them all. Net cash flow will only come when you are sure that there are no other inflows outflows. So 10,000 negative, 3,000, 2,000, 6,500. Discount factor 8%. These net cash flows reflect amount that will be received in future years. So convert it into today's terms by using discount factor table, present value. Zero factor is always 1. 8% year 1, 0.926. 8% year 2, 0.857. 8% year 3, 0.81. Sorry, 0.794. Multiply these net cash flows by the discount factor gives present value. 10,000 to 1 is 10,000 negative. 3,000 into 0.926 is 2,778 positive. 2000 into 0.857 is 1714 positive, and 6500 into 0.794 is 5161 positive. Sum them all to get NPV 1714 plus 2778 less 10,000. This gives 347 negative, indicating project should be rejected. Any questions with respect to example 1, 2, 3? Please ask. Okay, so there are no questions. We will keep today's class till here. And in today's class, apart from course outline, we learned and started topic number 1, capital investment appraisal. I've taught you two things. The first, what is appraisal? Checking whether opportunity is feasible for us or not. How do companies do appraisal? They follow a 6-stage process. The first step is forecast capital requirements. They try to find how much are the spare funds, then identify suitable projects which fall under the range of those funds, then check all projects to find which is the best one, the best is chosen and sent to management for approval, and funds are injected into the project, and then finally monitoring and control. Okay. The question, how to check projects? Projects are checked through different appraisal techniques. For appraisal techniques, NPV, IRR, ROS, payback are used. We've started the first technique, NPV. What is NPV? Present value of returns less investment. The format is make the columns of years 0, 1, 2, 3, 4. Whatever are the inflows and outflows, record in rows. Your investment, returns, scrap, etc., etc. There might be more inflows, outflows. Once you're sure all inflows, outflows have been recorded, net them all to get net cash flows, multiply with the discount factor to get present values, and the net of all present values is NPV, positive except negative reject. Okay. We are finishing the class for today at the moment. I've still not finalized the timetable because we have P4 classes as well, so we need to set up the timetable of them as well. At the moment, what I have planned that the classes will be held 3 days a week, Sunday, Monday, and Tuesday. I'm still not able to confirm you the perfect timings, but tomorrow, Monday, we will be meeting at 7 p.m. Pakistan time. Okay, it's not confirmed for every week, it's just for tomorrow, but I'm sure by tomorrow I will be able to give you a confirmed timetable. The days are confirmed, it will be Sunday, Monday, Tuesday, but confirmed timings I will give you tomorrow, Monday. It will be tomorrow 7 p.m. Pakistan time on Monday. Okay, I want one thing. I'm finishing the class since many of you has taken the online classes for the first time. So just to get the feedback that whether you are enjoying the online lectures or not, I want you all that after the class just WhatsApp me how was today's lecture and whether you were comfortable with the online class or not. Okay, thank you. See you tomorrow 7 p.m. Pakistan time.